Retail bankruptcies in the U.S. have been on the rise, with a 61% increase witnessed recently. Store closures have also surged by 77% in the past year. A new report released by Retail Dive, in partnership with credit reporting agency CreditRiskMonitor, has identified several retailers that are at a high risk of facing bankruptcy in the last few months of 2023 or have already filed for Chapter 211 protection and are on the verge of shutting down. The impact of these bankruptcies and closures will be visible during the upcoming holiday season, as storefronts darken and a shortage of products becomes apparent in many areas across the country. This trend is expected to have a lasting impact on the retail landscape for the foreseeable future. One retailer that is on the verge of bankruptcy is Petco, a pet supply store chain. Though Petco experienced a surge in sales and stock value during the pandemic, the reopening of the economy led to a decline in consumer spending on pet-related products. This resulted in significant losses for the company. Financial analysts have deemed Petco as a highly leveraged investment, and with slowing foot traffic and sluggish sales growth, investors began losing faith in the company. As a result, Petco's shares plummeted by 24% in August, and its market capitalization has declined by 65% in the last year. The company is saddled with a debt load of $3.03 billion and is currently on a bankruptcy watch list. Another struggling retailer is The Container Store, which saw fluctuating sales in the past few years. After a drop in sales during the early stages of the pandemic, the company experienced growth as stimulus money entered the economy and consumers were eager to spend. However, the trend of increased spending on home supplies and organization came to an end. The company witnessed a 21% plunge in net sales in the first quarter of 2023, which CEO Satish Malhotra attributed to a challenging macro environment. In an effort to reduce costs and improve its balance sheet, the Container Store announced mass layoffs. The company's stock also experienced a significant drop of 56% in the past year. CreditRiskMonitor sees a high risk of bankruptcy for the retailer in 2023. Big Lots, a discount retailer, is also facing significant challenges this year. The company has reported poor sales performance for multiple quarters, with double-digit declines in sales. In August, sales fell an additional 15%, exacerbating liquidity issues. CEO Bruce Thorn attributes the decline to inflation, which is hitting the brand's main customer base of low-income consumers hard. Additionally, the company's financial situation has been deteriorating over the past few years, with declining revenue, profit before tax, retained profit, total assets, and net worth, alongside increased liabilities. These factors have put Big Lots on the brink of bankruptcy. According to CreditRiskMonitor analysts, the retailer Noble House is facing potential bankruptcy, as it has experienced a 71% loss in market capitalization since October 2023. While the name may not be widely known, many people are familiar with Noble House's products. The company is involved in the distribution, manufacturing, and retailing of indoor and outdoor home furnishings. Its products are sold through various e-commerce channels, including major partners such as Amazon, Walmart, Costco, Wayfair, Overstock, Target, and Home Depot. Noble House also sells through wholesale channels, primarily to TJ Maxx, Home Goods, Marshalls, and Ross Stores. Established in 1992, this family-owned retailer offers products under various brands, including Christopher Nighthome, Noble House itself, Le Pouf, Okie Okie, Best Selling, and GDS Study. In recent months, the home furnishing sector has experienced a significant slowdown due to increasing costs, causing many Americans to delay home purchases and renovations. These market conditions have played a significant role in Noble House's decision to file for bankruptcy this month. The company is struggling with serious cash flow problems and owes millions of dollars to vendors in China and Vietnam. By filing for Chapter 11, Noble House aims to renegotiate its debt. However, the company's future remains uncertain. Consumers who frequently shop for home furnishings at major retail chains can expect higher prices and limited product availability in the upcoming winter. Rent the Runway, an apparel retailer that gained popularity by offering high-fashion items for rent, has experienced a sharp decline in recent years. With over 800 brand partnerships, sizes ranging from 00 to 22, and 3 main subscription plans, the business achieved great success, boasting over 11 million subscribers at its peak. However, the company's fortunes have taken a drastic turn for the worse. In 2020, the active subscriber count plummeted by almost 60%, and the company reported a loss of $171 million. Since then, Rent the Runway has faced ongoing challenges, including a restructuring plan that involves a 24% reduction in corporate employees. The subscriber count has dropped to 124,000 active members, and the company's stock has plummeted by 90%. CreditRiskMonitor analysts predict Rent the Runway will not survive beyond 2024. Farfetch, a luxury goods retailer, has witnessed a significant decline in its market capitalization, losing over 40% so far this year. This drop can be attributed to decreased demand in the company's top markets, the United States and China, due to concerns over inflation and recession. Farfetch also missed revenue estimates, resulting in what one analyst called a very disappointing earnings report. The brand additionally faced challenges due to retailers reducing wholesale orders for the fall and winter seasons, as excess inventories from spring and summer remained. CEO Jose Neves commented during an earnings call that the recovery has not been as robust as anticipated when the Q1 results were reported. Shares of the company were trading at $1.78, hitting their lowest level since debuting on the stock markets in 2018. JP Morgan and KeyBank downgraded their ratings on the stock, and at least 6 brokerages lowered their price targets on Farfetch, placing the company on the bankruptcy watch list. Showfields, a retailer that branded itself as the most interesting store in the world, recently filed for bankruptcy. The company's financial struggles began during the pandemic, as it faced lower-than-expected revenue streams due to low sales volumes during the national lockdown and the gradual reopening of public spaces across the country. Showfields saw no significant increase in revenue at its stores, despite the recovery seen by other retailers following the onset of COVID-19. CEO Tal Svi explained that the company was increasingly unable to meet its additional debt service obligations to its suppliers on time. Consequently, Showfields will permanently close its locations in Washington, Los Angeles, Miami, Manhattan, and Brooklyn in November. Another retailer that has recently closed its doors for good is Soft Surroundings, a women's apparel brand. In addition to clothing, the company also sold home decor products. However, since mid-2022, consumer demand for their offerings started to decline. In an attempt to cut costs and repay its debts, the company announced multiple layoffs a few months ago. Unfortunately, these efforts were not enough to save the brand, which faced significant financial challenges. Soft Surroundings is currently searching for a buyer to acquire its brick-and-mortar stores and a lender to restructure its online operations. AKA Brands, the parent company of popular apparel brands Culture Kings, Princess Polly, Petal and Amp Pop, and Red Dolls, is also facing financial difficulties. The company has been on the brink of bankruptcy since March, when it received notice from the New York Stock Exchange for not meeting stock price requirements. Quarterly sales dropped 18%, resulting in a significant net loss compared to the previous year. Although their stock has experienced a slight increase recently, retail industry experts believe there is still a high chance that AKA Brands will run out of money and be forced to liquidate its assets in the near future. The retail industry in America continues to be severely impacted by economic shifts, and even well-established brands are not immune to the challenges. The struggling chains mentioned above may just be the tip of the iceberg, as many more stores may face closure before the year 2024. This ongoing retail apocalypse serves as a reminder that success in the industry requires adapting to changing consumer preferences and economic realities. Thank you for watching.